Do the soft inflation data give you some solace, make you think maybe there's not as big a danger of that?
In the short term, yes. There's no question that the inflation numbers over the last few months have killed any talk of a September rate hike, and now the most likely next move is going to be in December. Between now and then, I think what we're going to see is a run of very strong labour market reports, just like the last two payroll numbers that we've seen, over 200,000. I think that continues. I think the unemployment rate continues to fall, and by the time the Fed sits down in December, we could be looking at a sub 4% rate, which they haven't expected and which no one on the Fed believes is sustainable. So I think that labour market tightening, rather than the actual inflation numbers, will ultimately push them to raise rates again. But certainly in the short term, it's given them, well, from a hawkish perspective, it's given them some breathing room. From a dovish perspective, it's given them perhaps some cause for alarm, because no one expected inflation to be weakening at this point. Chair Yellen has been pretty consistent in her view that it's been dropping because of specific one-time factors like falling cell phone service prices and prescription drug prices. That won't persist, and I agree with her. I think it is temporary. But it's been quite big, and it's lasted quite a while, and I think the period between now and December gives the Fed a chance to look at the next few run of numbers, make sure that that trend has flattened off again, maybe even picked up a little bit, and against a backdrop of a tightening labour market, that gets them raising rates again. But there's no question that the inflation picture has been a complication that really 3, 4, 5 months ago no one expected to be dealing with. It just looked like a straight line. They keep tightening every quarter, the labour market's doing the work, inflation's picking up, and now we have some uncertainty that's a new thing.
So I think that's really the key point. If I agree with Ian, if inflation accelerates, wage inflation accelerates, and therefore the Fed's far more aggressive, we are going to have some problems in the market. How much problems we can debate, but I think the market would not be at the same level of complacency. Having said that, the surprise has been that inflation really has not picked up. And even Janet Yellen, who was kind of categorizing it as temporary, has kind of changed her tune a little bit in her later testimonies. I think the proof point of all of this happens to be the dollar. So we have a market metric. If this market is going to be in trouble, we have to see a dollar appreciating and appreciating meaningfully. We don't see any evidence of that, and I hope from a worker's perspective, Ian is right, and we do see wage inflation going up, and it'll solve our longer-term problems rather than the market's problems. But today, as we sit here and how things look over the next 6 months, that doesn't seem very likely, and therefore reducing your exposure ahead just with that expectation has been a bad trade for the last 6 months, 9 months, a year.